So your bank is proudly advertising a 4% interest rate. Feels pretty good, right? But I've got some news for you. That 4% isn't your real profit. In fact, after we account for two little things called inflation and taxes, that gain could actually be a 1% loss. For the next few minutes, I'm going to walk you through the simple, deceptive math that shows how your savings are silently being eaten away. By the end of this, you'll know exactly how to calculate your real profit, and you will never look at a bank's interest rate the same way again. Point 1. The problem. The headline illusion. All right, let's start with the number your bank wants you to focus on. They call it the annual percentage yield, or APY. It's the big, bold number on the front of the brochure. Seeing it go up feels like you're winning. Imagine you put $10,000 into a savings account with a 4% APY. A year goes by and your balance is now $10,400. You made $400, seemingly for doing nothing. It's a clean, satisfying calculation. Your money grew. But here's the real question. Did your wealth grow? Did your purchasing power actually increase? Because the number in your account is only part of the story. That cozy feeling that your money is growing might just be an illusion, thanks to two very hungry thieves waiting for their cut. Point 2. The agitation. Inflation, the silent thief. The first and biggest silent thief is inflation. Think of inflation as a quiet tax on your cash. It's the rate at which everything gets more expensive. So if inflation is running at 4.2% for the year, that basket of groceries you bought for $100 last year will now set you back $104.20. Let's go back to our example. You've got your $10,400 and you're feeling great. But the world that money lives in has gotten 4.2% more expensive. That inflation has been working against you all year long. Your bank paid you 4%. The cost of living went up 4.2%. Suddenly, your real return, before we even talk about the next thief, is already in the negative. Your $10,400 at the end of the year actually buys you less than your original $10,000 did when you first deposited it. You basically ran on the financial treadmill for a year and ended up a few steps behind where you started. Point 3. The agitation deepens. Don't forget Uncle Sam. Just when you thought it couldn't get any worse, another hand reaches out for a piece of your pie. The government. The interest you earn in a regular savings account is taxable income. Your bank even sends you a handy little 1099 INT form to make sure you report it. Now here's where the math gets really deceptive. The government taxes you on your full $400 gain. It doesn't care that inflation made that gain worthless in terms of real-world purchasing power. You pay tax on the nominal number. Let's use a conservative 22% federal tax bracket as an example. And remember, this doesn't even include potential state or local taxes. So you owe 22% of that $400 gain. That's another $88 that's gone. Think about that. You earned $400, which wasn't even enough to keep up with inflation, and then you have to pay taxes on a gain that never really existed in the first place. This is the trap. You feel like you're earning money, but after inflation and taxes, you're left with less than you began with. Point 4. The solution. Calculating your true after-tax real rate of return. Okay, now for the part that puts the power back in your hands. You don't have to be in the dark about this. You can calculate your true after-tax real rate of return with a pretty simple formula. First, figure out your after-tax return. Take your interest rate, 4%, and multiply it by your tax bracket. If you're in the 22% tax bracket, that means you keep 78% of the interest. So your 4% nominal return becomes a 3.12% after-tax return. Now just subtract the rate of inflation. Your 3.12% after-tax return minus the 4.2% inflation equals a negative 1.08%. There it is. That's your real profit. A loss of over 1% for the year. Your $10,000, after a year of earning interest, now has the purchasing power of about $9,892. This is the number that actually matters. It's not about how many dollars you have, it's about what those dollars can buy. So, what's the big takeaway here? Always look past the headline number. The bank advertises the big, shiny nominal rate, but your real profit is what's left after you kick inflation and taxes to the curb. That's the only number that tells you if your wealth is actually growing. Now that you know how to see through the deceptive math, how does this change the way you think about your saving strategy? Drop your thoughts in the comments below. And if this video gave you a bit of an aha moment, do yourself a favor and hit that subscribe button. We've got a lot more to cover to get your money working for you, not against you.